Good morning. For those who are on time, I greatly appreciate it. Probably gonna give another minute or two. We got some stragglers today. A lot of people are registered, but I just want to give everyone a minute or two to get on. Thank you so much for those who are on. Appreciate you. Looking forward to some fun time here. Good morning, good afternoon, depending on where you're in the country. My name is Josh Elohim. I'll be your speaker for today. I really appreciate everyone getting on board. Hopefully y'all had a nice 4th of July weekend. Back to the grind here. So the purpose of the webinar today was the easiest way to sell IUL. Just some quick housekeeping for the call. Everyone's going to be muted just so we can get through this smoothly. If you have questions, you can go ahead and put those in the chat box and ask your questions there. I promise at the end of the presentation, I will go through and get your questions answered. So without further ado, let's go ahead and get started here. Hopefully everyone can see my screen here. More and more people are getting on. I don't want to leave anybody out. So hopefully you can all see my screen here. So the easiest way to sell IUL. We know that a lot of agents, from my experience, are comfortable with selling term insurance. When it comes to permanent or IUL, there's definitely a hesitancy, and that a lot of it comes to just not understanding what IUL is. I'm a very simple person. My gift from God is keeping things simple. So IUL stands for Index Universal Life. In the past, we had variable life insurance. Just to give you an easy analogy, variable life insurance was great. The market did 20%, you get 20% credit to your account, you're super happy. The problem was next year, the market did 20%, did minus 20%. And now your client's absolutely devastated. So what they did was they created IUL to offset the market volatility of VUL. So if I used to use the same scenario now with an IUL, it stands for Index Universal Life. And the biggest difference with IUL is they give you caps and they give you floors. So let's use that same scenario with the variable life insurance. With an IUL, if the market did 20%, you might get your 8 to 15%, depending on whatever the product that you're picking there. The next year, when the market does minus 20%, now you have that zero floor. So the way it works with IUL is you're going to participate in the upside of the equation, but not the downside. Does that make sense, everybody? And then the IUL is based on the S&P 500. There are some companies that do have different indices you could be a part of, but if you want to keep it simple, you can have your client be in the S&P 500. Whatever the S&P 500 does for that year, that's what gets credited to your account. It's pretty straightforward. So let's have a look here. I'm going to go ahead and just, hopefully you're all familiar with our quote and apply system, right? So I'm just going to kind of have some basic information in here. I'm going to next my way through. So we're just going to use someone born in 1980. Let's say no thanks here. And we know how term insurance works, right? So our term comes up here. So one of the things I'm going to talk about with you, I'm sure you all heard the term buy term and invest the difference. Well, what I said, term insurance provides a great need, right? So in one of my scenarios I'm going to show you in a little while, I'm going to explain to you how you could take care of the term insurance on the front end to figure out what that protection need is. And then next question we're going to ask is about permanent insurance. Let's just go to lifetime coverage here, okay? You have a few different ways and options you can run this on quote and apply, but ideally you want to have your client on the phone with you. Why is that so, Josh? Well, you and I both know in the past, this could take 5 or 6 meetings going back and forth. You meet with your client with your illustrations you have, or maybe you don't even have any illustrations in the beginning, ask them what their needs are, and then you have to go back to your wholesaler. Now we can do everything at one time. So what I'm going to do here is I'm going to go to this accumulation IUL. Does everyone see that right there? So we're going to run a permanent illustration here literally within seconds. I mean, it blows my mind. We just get faster and faster. Did everyone see what just happened right there? I mean, no, for agents who have been in the business for a year or two, this is how you think that things should be. The ones who greatly appreciate this are the ones who've been in business 20, 30 years, you know, the ones that used to do illustrations with rocks and a chisel. So you understand how quick what you just saw was right there. So when we run this scenario, this is what we call a max non-mec. So we got $1 million death benefit here, right? I'm a big believer in these two scenarios we're going to run right now. The first one's called the max non-mec. Does everyone see that? The beauty of this software is that we forget that people learn not just from hearing, but also seeing. With the software, not only can I tell you things, but I can also show you. So when I say the word max non-mec, you can see it right here and look at it at the same time. That's when things click, right? But what is a max non-mec? What that means is based on this $1 million death benefit, what is the most amount of money that we can put into a policy without mecking it? I'm sure you all remember what a mec is, right? I'll remind you though. Mec stands for Modified Endowment Contract. Life insurance was so good in the past, you could put $1 million in and you could take $1 million out tax-free. Who wouldn't want to do that, right? Life was really good a long time ago. And then the government stepped in and said, wait, we haven't gotten our piece of the pie yet. We want to get our money. So they created what's called the MEC, the Modified Endowment Contract. All it simply means is that if you put too much money into a contract too soon, then you're going to have to pay taxes on the first dollar that comes out. Does that make sense, everybody? Now, I don't go over this. I sometimes go over this with the client just to kind of keep it very simple, but I'm just going a little more deep for you as well, just to make sense here. So we're showing a max non-mec based on $1 million. If you look here, that means I could put as a 42-year-old, I can put in $57,000 a year into this contract, just only having $1 million policy. How is that possible? Because I'm doing the most money possible based on that $1 million death benefit. So Josh, what's the, this is, to me, there's two ways to do this. This is one of the best. I wouldn't say this is the absolute best, but it's one of the best. When do I use this scenario? Well, I use this scenario when someone says, hey, I want to have a set death benefit, or I want to put in the most possible into this contract. And there you go. There's $1 million death benefit, and this is the most you can put in per million for $1 million death benefit. So that's called the max non-mec here. I do want to show something very quickly here as well. A lot of people go deep into these illustrations. They go deep into, sophisticated stuff, and you've lost a client like 3 hours ago. So what a question I'd like to answer, you could do this before you even start the presentation, but if you look here, does everyone see this tax-free income? See this bucket, see this right here? This is a great story to tell people, and it's a very simple way to keep things easy. I know we know all about the acronym, KISS, keep things simple, stupid. Well, here you go. What do people hate more than life insurance? And I know a lot of people hate life insurance, right? How about that? Paying taxes, right, Susan? So we know people hate paying taxes. This piece here shows you my top income earners and my top tax rates. And when you add this up in California, we're close to 50%, which is why most of you probably don't live here, right? I call this the bucket sheet because if you look here, this is where your client's money is right now. So we have 3 buckets. We have a tax-deferred bucket, your 401ks. To me, it's a great bucket. If someone's willing to match you a percentage for a company, I would put that 5, 7%, whatever they're matching into this. I would not do more than that personally, but that's a great opportunity. I just helped out a friend personally. He had his own company and he was maxing out his 401k, but he was the owner of the company. And I said, do you realize what you're doing here? And I showed him this bucket sheet, and he was putting away about $3,600 into this. He had other buckets as well. But once I showed him how he's being taxed on this bucket, he changed his tune, and we ended up putting $2,000 a month into an IUL for 10 years. You just have to educate people. Your job is not to sell anything. It's merely just to spread the good news. If you're not comfortable doing this, use me. That's what I'm here to help you guys and gals. I can get on the phone with you / for you, and I will do this presentation. I'm very friendly, I don't bite. So you have your tax deferred bucket. Again, to me, it's a great bucket. Then you have your taxable bucket, your stocks, your bonds, your mutual funds. Another great vehicle. It's like, where else can you put in $100,000 and earn $1 million? Probably nowhere. So another great vehicle. I work with a lot of financial planners, right? And there's a big misconception about cash value life insurance, that this is going to take away from your AUM, your assets under management. Actually, what it's really designed to do is to protect your assets under management. So, and I'll show you why in a second here. Then you have your tax advantage bucket, which is like your Roth IRAs. This is a great bucket as well. The problem with that bucket is people who make too much money, they don't qualify for that bucket. So again, you get people's attention because now we're talking about your money, correct? Not just some stranger. Now you could have a real estate bucket on here as well, right? That's another vehicle, but it's the same kind of concept, right? If you have to sell your real estate at a time the market's not up, you could be in trouble there. The problem I see is people focus on growth. I want to make as much money as possible. What do they forget about? Distributions. So what happens when I want to take this money out? That's the challenge that I've seen. So if you look here, does everyone see these little spigots right here? So again, it's people focus on growth, they forget about distribution. So this shows me how am I being taxed on these three great buckets, pre-59.5 to 7.5. Does everyone see that? Most of your clients are probably going to be in that 59.5 before range. They don't know they're going to get hit with an ordinary income tax plus 10% penalty if they want to take money from these buckets here. I'm not downplaying these buckets. They're great vehicles. I would never tell anyone to put all their money in the life insurance. To me, that'd be foolish, and I sell life insurance because there's other great vehicles out there. I'm a big believer in two things here. I call this a forced savings account because Lord knows as Americans, a lot of us are guilty of this, but we're not saving enough money. What does that mean? That means we're going to be working for the rest of our lives, right? But the second thing I call this is diversification. A lot of people are not diversified in their portfolios. So they're going to, when they need money from these buckets here, they're going to get hit with some pretty hefty taxes, and they don't even know it. So here's your sale. What if there's a way, if I could show you how to create non-reportable tax-free income? Is that anyone be interested in that by a raise of hands, which I can't see? No one said no to that in 12 years now. So, well, obviously you would, right? Well, there's one more bucket you may not be familiar with, and that bucket's called life insurance. A lot of people say, I thought life insurance was for a death benefit. No, that's called term insurance, right? So this piece shows you how am I being taxed in this great bucket, pre-59.5 up to 70.5. And as you may or may not know, the real beauty of cash value life insurance is the money grows tax deferred. I can take the money out tax free, and the death benefit is also tax free. It's like, where do I sign? Once people get this, you'll know when they're on the phone with them and they get it, they should say, well, how much money can I put into this? And that's where you have to remind them about the whole MEC, which is what I kind of started with, right? But that brings hopefully in the full circle there where you can't dump too much money in or else you have to pay taxes on the money that comes out. Does that make sense, everybody? That's where you know you've got the person and they're listening and they understand is how much can I put into this? This sounds too good to be true. And that's where the MEC comes in. But just as a reminder, what are we doing here? This is called the bucket sheet, by the way. A lot of people ask me to send this to them, but if you look here, it's right in the illustration. When you run your quote, let me show you. All I have to do is hit this show policy details, tax-free income. Does everyone see this click here? That's how I get there. I click right there. Now I'm going to use this as a reference point. I'm going to go back and forth here, okay? So let's look at the max non-MEC. So I can actually click on this PDF here, and I can go into the illustration. Wait a minute, we can dance on the spot here? Right on the spot. We can do some salsa here. We can look at the illustration right in front of the client. People learn by hearing, and they learn by seeing. Those are the two factors of how it sticks in people's brains. So let's go ahead and have some more fun here. So we got a male 43. That's a great age to do this. The earlier, the better, right? Who knows the best age by a raise of hands? Who would be the absolute best person to do this with? Anybody? Anybody? It'd be a 1-year-old. Why is that correct? Why would a 1-year-old be the best person, right? So if you look here, did everyone see what I just did here? I mean, we're in the illustration on the spot here. People don't have time for you to come to their home anymore and spend 3 hours at their dinner table anymore, right? So now we can do this right on the spot here. It's an absolute game changer. So I can dive into this, right? So I'm gonna explain this, but I also want to show how I would run this, okay? This is a full pay. So we got a male preferred 43, and we're paying $43,000 a year. And if you look here, we're doing this for every single year. Does everyone see that? So we start off with our $1 million death benefit that I explained, and the policy is just going to grow because the cash value is growing. I'm not a big fan of doing it this way because who wants to pay premium when they're 84 years old? I don't. I wouldn't want to. So your client's like, hey, this is great. I like what I'm seeing here. What about just paying for 10 years? I can scroll down here now, and I can change this to a 10 pay. Does everyone see what I just did? So you can make changes and pivot like you never have in the history of our business. This is why we're seeing things going from 5 meetings, 6 meetings to 1 or 2, because I can really just make changes right on the spot here. Does everyone see what I just did right there? So now you're asking me these questions. I can answer them on the spot. We all know what happens when every question gets answered. Then they say, what's next? We'll get to that point. So I just made the change to a 10 pay. This would probably be my best recommendation here, okay? Now, obviously, the person has to be able to afford this, but the beauty is that I can just lower my death benefit if I want to get the premium to where the client's comfortable with. It's more important to understand the concept of why we're doing this as opposed to, you know, making the client want to buy it right this second. So does everyone see what I just did here? I just changed it from a full pay to a 10 pay. So now we're paying $59,968, right? We're doing that for 10 years. So if I'm a business owner, which I believe is one of the best clients to offer this to, if I'm a business owner and I can see 10 years down the road, when you say talking about paying premiums into my 80s and 90s, that could scare me off there. This is what I would recommend. So here's my 10 pay, right? So here we go. I put in $599,680 over 10 years. My policy value is what's currently growing in the policy right now as we speak. My surrender value is if you said, hey, I want to take every dollar out of this policy and I want to walk away. Obviously, this is not a good investment, which I don't like to even call it an investment, but it's not a good policy if your plan is to take all the money out year one. It doesn't make any sense. But look, so these policies have surrender charges in the earlier years, hence my surrender value. They don't want you putting the money in and taking the money right out. But if I scroll down here to about year 13, does everyone see that number is equal now? Well, what does that mean, Josh? That means that my surrender charges at that point are gone. So that's really how it works here with the surrender charges, okay? Now, there's always going to be cost of insurance charges. Well, why? Well, if you bought this policy today, correct? And you put $59K into there, and you weren't here tomorrow, guess what? The carrier's on the hook to pay out that $1 million policy. Well, because that's why there's cost of insurance charges, because the carrier's on the hook for that amount. Not a bad investment, by the way, not for you, but for your beneficiaries, right? So that's why there's fees and cost of insurance charges here. So if you look, this policy grows and grows over time. This is based on the S&P 500. We're running this at a 5.04% interest rate. Does everyone see that? For me, this is actually being very conservative because the S&P 500 over the last 30 years has averaged around 10% with the highs and the lows. Now, when you factor in a cap and a floor in this product, I would say you're more looking at probably 6, 7, or 8% here that we can get on average. We're showing 5.04%. If your client is happy with this, they're going to be very happy with. We all know if we get one more point here, it changes everything, right? So let's have a look here. So this person's put in $599 because they have time. This is not a secret. This is really just compounding interest, right? Money growing on top of money. So at their age 65, let's call it 66, they've still only put in that $599. The number is not changing, right? So they have two options. They have access to about just over $1 million of tax-free income. So in essence, they've doubled their money. Or the smartest way is to use this to supplement their retirement, because maybe they have money in these other buckets I showed you, right? They have money in these buckets right here, right? So they don't want to have to pull from those buckets. Well, let's use this as a supplement. So let's go back to our illustration. This to me is the smartest way to do this, right? At that point, I could pull out 75K from 66 all the way to age 90. At that point, I pulled out, let's have a look here, $1.7 million of tax-free income. Does everyone see that right there? So I've taken my 600K and I've done some tremendous things, right? And by the way, I still have a $322,000 death benefit at age 90. Does everyone see how that works there? I mean, this is a pretty robust system here. Is this designed to beat the market? It's not designed to beat your third bucket there. So some real benefits that I love to talk about to help the client feel comfortable. First thing is that we call this a flexible premium contract. You see how everything I say, I show, right? Well, what does that mean, Josh? Well, in this situation, we're showing a 10 pay. We're paying for 10 years. Let's just say business is really good. And I want to, in year number 11, I want to keep paying. You can pay in year 11 if you want to. Vice versa. Let's say you have a really rough year and you can't make the payment. Well, guess what? Let's say year 7, rough year. Because you have cash in the policy, you can use this cash to skip a payment. Now, obviously, it does affect your numbers. I'm always transparent about that. But I'm just saying you have options because you don't know what's going to happen, right? Your client loves to hear that part. The second thing they like to hear is that after the first year, you have access to your money if and whenever you want for whatever reason you want. Now, I'm sure you've all heard this bank on yourself, become your own bank. This has been around for a long time. They're just putting a new spin on it. Just a heads up, okay? Because you can become your own bank here because this is your money. You could take this money out via a loan if you want to, and they'll charge you 1 or 2 or 3%, but they credit you back 1 or 2 or 3%. So we call it a wash loan. If you want to take some more risk, you can do an index loan, and you can basically come up on your money. So you have a lot of different ways to, this is your money. You can do whatever you want with it. So I asked a question here now. So now that I know that I can borrow from this, by the way, I tell people, try to do your best to not touch the money during whatever funding phase you pick. So if you pick a 10 pay, I would encourage you not to touch the money during that 10 years. Does stuff happen? It does. But that's just my encouragement, okay? So here you go. Now I like to go back and forth. And let me ask you this question, Mr. and Mrs. Client. If you need 20, 50, 100 grand, which bucket do you want to pull from here? I'll wait. The answer is I don't want to pull from any of these buckets, correct? Why? Because look, now I see how I'm being taxed on these buckets. So let me refresh what I said before to you. This vehicle is not designed to beat the stock market. What is it designed to do? Protect against this vehicle. Because we know as a financial planner, and I work with a lot of them, they don't want to keep this money in here growing as long as they possibly can. They don't want the client to touch it. Well, guess what? Now you're giving them a vehicle that they have access to if and whenever they want for whatever reason they want. It grows tax deferred. They take the money out tax free, which I'll explain in a second here. And they the death benefit, money goes to death benefit tax free as well. Are we doing this to beat the stock market? No. So let's have a look here. Another thing people like to hear about is this whole tax free. It's kind of a gray area. Like, is it really tax free? Here's how I explain it. Whatever money you put into your contract is called your basis. So in this hypothetical, we're putting about 600K into our policy, right? Now, life insurance is paid for with after-tax dollars. That gives me the ability to take the money out tax-free. Does that make sense, everybody? But here's how you physically do it. So because I've already paid taxes on the front end, if I want to just kind of take the money out for income, I can do what's called a withdrawal. It's just like calling your bank and saying, hey, I want to take money out. They're not going to ask you any questions. So when I pull out this hypothetical 75 a year, I'd probably do this via withdrawal if I'm using it for retirement income. If you want to do that whole bank on yourself concept, then you would use loans at that point. So let's just go with this scenario. We're going to do this via withdrawal up to my basis. So hypothetically, I hit my basis right around here, right? So once I hit that basis, now I'm going to change over to a loan. Like I said before, you heard the terminology become your own bank, because this carrier is going to charge you 1 or 2 or 3% to borrow the money, but then they'll credit me back that same 1 or 2 or 3%. We call it a wash loan. If I want to get a little more aggressive, I can do index loans. I can bank on, and then if they'll charge me a higher percentage, but if I get a higher percentage in the market, in the S&P, then that money just grows. So that's really how you take the money out. Now, here's a key factor with these policies. As long as you never surrender the policy. In other words, in this hypothetical, we pulled all this cash out, right? And at age 90, if you hope to live to that age, we still have a nice death benefit here. And we still have cash growing in the policy, correct? Does everyone see the cash still there? So as long as you never surrender this policy and you die with it, you're never going to have to pay taxes on the gains in the contract. Does that make sense, everybody? Because the death benefit is what? And always is what? Tax-free, correct? So let me say that one more time. As long as you never surrender this policy, you pull as much cash out as you need, you never kill the policy, and you never surrender the policy, you're never going to have to pay taxes on the gains in the contract. This carrier actually took it a step further, and they have something called an overloan protection rider. Have you ever anyone heard of this before? What does this mean? What this rider does, it protects the client from themselves. If this policy is gonna ever die because they're pulling out too much cash value, it'll automatically shut off and turn into a paid up policy. Does that make sense, everybody? So it's a free rider, it's a great rider, it protects the client from themselves. So they never have to pay taxes, and they never have that phantom income bill. That's called an overloan protection rider. If you have questions, please put it in the comments. Let's go back to the meat and potatoes here. So there's my illustration. There's how the accumulation, so how does it grow? We talked about that. How can I pull money out? We talked about that. Is it tax-free? We talked about that. Please put your questions in the chat box, right? So there's one phase that people don't like to talk about, agents, and I sleep very well at night. But we have I call this the Armageddon column. But if you look here, let's scroll up for a second. In every illustration, you're going to have what we call the zero column. Does everyone see this right here, or the guarantee column? The way this works is by law, if you have any type of cash growth in a policy, by law, you have to show the absolute worst case scenario. Does that make sense, everybody? So what does that mean? Well, I call this Armageddon because there's two things that have to occur which have never happened in the history of our business, but you have to show it by law. Well, the first thing is that the carrier, life insurance carrier, in this situation, John Hancock, has to charge their maximum cost of insurance charges every single year in this contract. Boom, boom, boom. It's never happened in the history of their business, and they've been around hundreds of years. The second thing is even crazier. The S&P 500 has to zero every single year. If those two things were to occur at this client who's 43 now, at age 66, you'd have to put more money into the contract. Does everyone see that? Now, would you all agree if the S&P 500 is zero for 23 years, every single investment this client has is in a world of trouble? At that point, we're really fighting for food and survival. Would you all agree? Life's going to be pretty crazy. So what do we think is going to happen? Again, I like to show it, though, so no one can ever come back to me and say, you never told me about this. Well, no, I did. So here you go. What do we think is going to happen? This is the column that we think is going to happen here, okay? This is called a max non-MEC death benefit. Does that make sense, everybody? The most money I can put in based on $1 million. So I want to show you one more scenario that I'm also a huge fan of. Obviously, the max non-MEC, these are big premiums, right? So not every time people can afford it. Now, if I want to lower that, watch this. Because of our software, I just put in 500. Now watch what happens here. So I can go down to $50,000. There should be something for everybody. Does that make sense? So I just cut that in half, right? There you go. I can go down to 50 grand there. I'm also a huge fan of what I'm going to show you next here. Normally I go through the whole the application, but I want to spend more time here today. So if you look here, I'm a huge fan of what's called a minimum non-MEC. Now, because sometimes people just have a certain dollar amount of what they want to spend. Well, when I go to minimum non-MEC, let me tell you what happens. You see how it allows me now to plug in, instead of a death benefit, I'm going to plug in the premium. Did everyone see that? So remember we talked about that buy term, invest the difference? Well, here's what I'm a big fan of using term insurance. I don't like to even call it term. I like to call it protection, by the way, using protection insurance to cover that if I'm not here tomorrow. Well, that's what you can use to cover that high death benefit, because that's where a lot of the cost comes with these insurance policies. Cost of insurance charges. Well, if I need $5 million, why not just get a $5 million term policy for 20 years, 30 years, whatever I need that for? So when I do a minimum non-MEC here, now watch this. I can actually ask Mr. Klein, after I've gone through my bucket sheet, how much money are you comfortable putting into this policy on a monthly or an annual basis? So let's just change this to monthly, right? So let's say the client was comfortable putting in $1,000 a month, and we're going to do that for 10 years. When I do a minimum non-MEC, there's two really important things that happen that help your client out. The first thing is when I lower my death benefit all the way down to the minimum, it lowers my cost of insurance charges down to the minimum. Does everyone see that? That's what the cost of insurance charges are based on. Now that max non-MEC was not the highest death benefit. That's still a really good option. I could dump a lot more money into that one. That's why I like that one. The minimum non-MEC is more geared towards, I have a certain dollar amount I want to put in. So again, first thing is it lowers my cost of insurance charges down to the minimum. The second thing is it also lowers the agent's commission. Sorry, everyone on the call. So I like to joke around with the client, like, hey, if the money's not going to Sean, the money's not going to the carrier, where is it going to? It's going to my policy so it can grow faster, right? So when I do that minimum non-MEC, here we go, 10 pay. I'm going to hit the rerun quote button. So let's just see kind of the difference here and what happens to this policy. So just to make it easy, I'm going to keep it apples to apples here. So again, I showed you a max non-MEC, and that's not the max non-MEC death benefit, that's the max non-MEC premium, the most I can put in premium-wise based on my death benefit without MECing the policy. Now we're looking at a minimum non-MEC. So if you look here, this was the policy I actually helped a good friend out with. So he's very happy. You know, he's diversified now, and he knows that he can pull money from this policy upon his retirement without getting killed on taxes like he is with his other vehicles. So let's go down to the meat and potatoes here. Okay, let's zoom in. How cool is this control here, right? So here's my minimum non-MEC. All right, so I got $1,000 a month here. We got a 43-year-old preferred. Look at my death benefit now. Instead of $1 million, it's $196. Does everyone see that? Lowest death benefit possible. Here's my $12,000. Again, we're doing this for 12 years. So a really simple way to figure out, like, what are my cost of insurance charges the first year? I just take my $12,000, I subtract it from my policy value, which is currently what's growing in the policy. Those are my fees for the first year. So about about $3,500 there. Those are my fees for the first year, right? And then if I want to surrender, those are my walk away, what I get. Normally, you can see if you run these policies correctly or incorrectly, because the ones with the really high death benefits are going to have zeros for the first 4 or 5 years here. That means the cost of insurance charges are so high that there's no money for the client if they want to pull money out. That's how you can tell. You see how we have cash right away in both these scenarios? Let me go to the other scenarios. So now we can look at both of them together, okay? So again, we have cash right away in both these scenarios, which is why I like this. People like to see where their money is, right? Okay, so let's go back to our illustration. Here we go. So in this hypothetical, now we're putting out 120 grand. So I like to show two options, right? Instead of putting in 600,000. And the client can guide you what works best for them. I always at the start of $1,000 a month. They can go up, they can go down. Again, the case that I did with my good friend was $2,000 a month, right? So, but I started at 1,000. He said, what does 2 look like? And I'll show you how to make that pivot here. So in this hypothetical, I put out 120, obviously a lot less money, but I still have my 120. I have access to 192 of cash value. That's what's in my policy. Or I could use to supplement my retirement where I take out that 13,000. And in this hypothetical, at age 90, I pulled out 309,000. Does everyone see that? off my 120, and I still have my 66,000 of tax of death benefit. That's really how these policies work. They're extremely simple. But when your client's like, hey, this is great, what about this? What about that? Now that I see how this works, what does 2,000 look like? I put in 2,000. There we go. And I hit the rerun quote. What does 500 look like? So there's something for everybody here. Does everyone see how that works? I can pivot with the best of them here. I have clients that ask me about long-term care. I can add a long-term care rider. So I can do that. So I can jump into here. Does everyone see the with LTC? There you go. I can do that if I want to. Listen, do me a favor. I am extremely comfortable having these conversations. If you're not comfortable, just set up a call with me and your client. I will jump on the call with you / for you, and I'll do this presentation. I won't even go on the application. I'll do them, you're all smart people. You hear 2 or 3 of these things, you're hitting the ground running. If you need me at number 5, we might have to have another conversation. But again, I don't make $1 until you sell something, so I have every opportunity to want to help you out. So in a nutshell, that's IUL. That's how it works. I'll show you 2 of the closing scenarios I use. And again, I don't know if they're really closing, but when we go through all the options, the clients might say, what's next? We all know what that means, right? Well, I'm like, whoa, slow down there. I'm glad you like John Hancock, but they want to date you as well, meaning an application and an exam. That's all you're saying yes to right now is an application and an exam. We still have to go through that to see, because we just guessed on his health, right? We don't know exactly where we're going to be at. Once those numbers come back, it's very easy for us to manipulate and to get where you want them to be. Another question that comes up is, I don't know how much money I should put in. Let me talk to my wife. Let me talk to my family. Let me think about that. Here's a very easy rebuttal for that. Well, what I recommend is apply for the most you possibly might want. What's the most you want? Is it $1 million? Whatever that number is, right? Once we get the offer, it's very simple for us to come down to fit your budget. It's a lot harder for us to start low and then go high, because they could ask for more underwriting stuff. Does that make sense, everybody? And then they usually say, that makes sense, let's move forward. And then you all know we hit this continue button, it goes right into the application, right? And we can do our whole application right there on the spot. Hopefully you've all seen this before. You know how the application works. If you don't, I'm happy to go through it step by step. But I really want to spend more time focusing on these 2 options. So just to recap, we talked about 2 things. We talked about a max non-mec, which is what this, when I do the IUL, it just automatically shows up at a max non-mec. This is based on a death benefit. So I plug in my death benefit, and that's going to be the most I can possibly put in based on $1 million. So if someone doesn't want to have that term insurance option as well, they want to just do all permanent, there you go. This is a great option here. By the way, this death benefit is still a lot lower as well, based on putting in 60 grand to this contract. So it's the same concept where the agent gets less commission with the max non-mec as well. We do have the greedy agents out there. I know everyone, they're out there. Josh, what's the best way to run this so I can make the most money? It cringes me to have to answer this question, but if that was the case, you would run it at target. Does everyone see target premium? You didn't hear it from me. But I had an agent who, this platform was out, it's been out for about 6 years now, but it had been going for 5 or 6 months live, and he couldn't wait for it to go live. We only had the minimum non-mec option. He said, Josh, I'm like, why haven't you sold anything yet? You were so excited for this. He goes, I only run things at target. I said, oh, you're that agent. I said, you're the greedy agent. And he paused for a second. He said, yeah, that's me. You got me. So listen, I want to do what's right for my clients. And I feel like the 2 scenarios I just showed you are the absolute best way to put your client in the best place possible to succeed with these policies. Highest death benefit, lowest cost. We know what happened with those policies years and years ago. They all blew up. Let's not do that. Let's do this thing the right way. I always joke around and say, hey, we're not going to get rich off this one policy, Mr. Client, but if we sell 20 or 30s, it might be a different story, right? Perfect. Well, you learned about max non-mec today, you learned about minimum non-mec today, and you learned about what a mec is, how that works, right? So again, we're trying to be as efficient as possible for your clients. We also learned about that we have this bucket sheet here that we can discuss and explain with the client about how this works. These are great visuals for your clients. Listen, why is this the best for, if you say, who should I focus on here? Your business owners. Business owners are phenomenal with this. Why? Because they can pay the premium out of the company. I mean, I don't know what else we can do to help people out. They can pay it right from their business. So you go through this whole presentation. At the end of the presentation, you tell the owner, you can pay for this out of your company. By the way, it's really good to add the long-term care rider with business owners, because then if there's two business owners and one of them becomes disabled, they can't work, they may be able to use that long-term care to pull out of the policy to protect the business owner. So again, huge fan of business owners. Obviously, if you want to put this on kids, a 1-year-old, it looks absolutely phenomenal. If you want to do that, just there is a rule, they'll give the kid half what the parent has. Unfortunately, because the worst case scenario has happened. But so let's say the kid's looking at a $500,000 policy with that minimum non-MEC or max non-MEC, the parent has to have at least $1 million. It could be term, it could be permanent, whatever. It doesn't have to be permanent insurance. Well, hopefully this has been helpful for all of you on the call. Not one person has dropped off. That's always a beautiful thing. Please go ahead and ask your questions. We want to help you to offer your clients more cash value policies. And what are we really doing for them? We're creating a fourth bucket that your client does not have access to right now. And that bucket is a non-reportable tax-free bucket they can pull from if and whenever they want for their retirement. How do their clients say no to that? You just have to educate them. They just don't know about this. Please help me to help you, to help me to help you, if that makes sense. Let's help us. Thank you so much for all your time. Please go ahead and ask your questions. Put them in the chat box. I'll go through them. I really appreciate all of you. I see some familiar names on the call here. So I'm hoping there'll be some good questions. If you need me, please reach out to me. Here's my contact info on the screen here. You can also, if you have a client, hey, I have a client that I want you to kind of talk with, Josh, one of my good clients, meet with Josh. See it right here? Just book a meeting in my calendar. It's very simple. You can meet with me. Just let me know that we're meeting with so-and-so client, and I'm very comfortable. I'll even wear a jacket if you want me to, okay? Listen, I really appreciate all of you. I really appreciate your time. Let's go ahead and start educating our clients on permanent life insurance and give them a chance to help for their retirement income to protect us all against these rising taxes, right, that are coming at some point. Thank you again. Put your questions in the chat box. I appreciate all of you, and have a blessed day. I'll wait a second here. Questions. I know someone's got a question. They can't be that good. Anybody? All right, I'll assume that you're all professionals and you sell tons of IUL here. I'm looking at some names. I don't want to call anybody out here, but I will if I need to. Any questions, you guys? Perfect. Well, listen, I really appreciate all your time. I thank you for being on. Hopefully this helps you to start looking into your book of business and seeing which clients might potentially want to create non-reportable tax-free income. Thank you for your time and have a blessed day.